Assalamualaikum warahmatullahi wabarakatuh, and hi everyone. It is my pleasure to welcome you to this presentation on the management of Takaful Fund. Before we begin, let me to introduce the members of our group who have worked together on this presentation.
Assalamualaikum warahmatullahi wabarakatuh. Before we begin our explanation about Takaful Fund Management, I would like to tell you guys about our research objective under our research title. First, to explain the fundamental concepts and Sharia compliance structure in Takaful Fund. Second, to analyze the various fund structuring model used in Takaful. Third, to propose challenges and explore potential innovation in Takaful Fund Management.
Today, I will be talking about a very important component of Islamic finance, the administration of a Takaful Fund. This system is not just about insurance. It's a unique Sharia compliance structure based on mutual cooperation, shared responsibility, and ethical financial practices. So, let's begin with the basic. What the meanings of Takaful Fund? Takaful means share guarantee or collective insurance. In a Takaful system, participants contribute to a common fund that is used to support any members who suffers a defined loss. This reflects the Islamic spirit of solidarity and helping one another. The core of Takaful lies in what we call the Tabarruk Fund. Participants donate a portion of their contribution into this fund, not as a fee, but as a gift to support others in need. The fund is then managed by a Takaful operator who act as either an agent under a wakalah contract or a manager under a mudharabah or profit sharing model. Now, an important aspect of the operator's responsibility is investing the fund in a Sharia compliant way. This means avoiding three aspects. First, riba or interest, gharar, which refers to excessive uncertainty and other non-permissible elements. Why we need to avoiding that? It is because to ensure all activities stay within Islamic principles, the operator is guided by a Sharia advisory council. In Takaful Fund, we must clearly separate two types of fund. First, the Participants Risk Fund (PRF). This is used to pay claims. Second, the Participants Investment Fund (PIF). This one is for investment. Each has different risks and purpose. So, separating them ensure transparency, proper governance, and Sharia compliance. Managing the fund also involves underwriting and claims processing. Contributions are calculated using actuarial assessment to ensure the fund can cover expected claims. If there's a surplus at the end of the period, after paying claims and expenses, it can be shared between the participants and the operator based on a pre-agreed ratio. This encourages responsibility, fairness, and transparency in the system. The operator earns revenue primarily through wakalah fees and in some models through a share of the surplus or profit. But that's not all. The operator is also responsible for managing risks like market risk, credit risk, and liquidity risk. They must also appoint qualified fund managers and ensure all activity remain Sharia compliant. What happens if the risk fund is not enough to pay claims? In that case, the operator can step in with a card, which is an interest-free loan, or may accept a hibah, which is a gift to cover the shortfall. This way, the fund remains solvent and operational while still adhering to Islamic values. So, the administration of a Takaful Fund is a delicate balance of ethical investment, mutual support, and strict Sharia compliance. It's not just a financial product. It's a system that promotes community cooperation, justice, and trust. And in doing so, Takaful offers a powerful, faith-based alternative to conventional insurance, protecting both the participants and their value.
Hello, my name is FATHIATULHUSNA binti Muhammad Afandi. My matric number is 2022869092. Find strategic model in Takaful. So, Takaful operator worldwide use various models to manage contribution in line with Sharia principles. Unlike conventional insurance. Takaful model required through approval from qualified Syariah scholar. A model acceptance in one region may not be recognized in another due to differing interpretation of Sharia law. For instance, while in Malaysia commonly use the profit sharing mudharabah model, it faces security and in the Middle East. In Pakistan, scholars favor the wakaf model over the wakalah model for better alignment with Islamic principles. The four main takaful models are mudharabah, wakalah, wakaf-based and hybrid. The little combined alignment for the first two. Choosing the right model depends on 5 factors. First is Sharia compliance. Second is business feasibility. Third is regulatory environment. Next is a local stakeholder acceptance. And last is target demographic characteristics. In the next session, we will explore the particular application of these models in the takaful industry, assessing their effectiveness and challenges in different contexts. First, mudharabah profit sharing model in takaful. In the mudharabah model, a capital provider, Rabbul Mal, supply fund to the entrepreneur mudarib, who manage the capital according to agreed guidelines. The goal is to generate profit, which are shared based on the pre-established ratio, avoiding interest and aligned with the Islamic finance principles. In the takaful industry, participants contribute premium to a common fund managed by the takaful operator. The operator investment the funds and handles claims during the AFANDI events. Surplus or investment profit are shared between the operator and the participant according to the agreed ratio. This model promotes transparent risk sharing and ethical investment, making it ideal for Islamic insurance system. Next, wakalah agency model in takaful. The wakalah model in takaful operates as an agency-based system. In this structure, participants are the rightful owner of the takaful fund, while the takaful operator serves as their agent, managing the fund of their behalf. The operator receives a predetermined agency fee, which is established in advance, deduct from the regular contribution made by participants. Notably, this fee remains fixed and is not influenced by the fund performance. In addition to the agency fee, regular contribution may incur other charges. This includes service fee and asset management fees, which compensate the operator for the representing and managing the interests of the participants. Optionally, the operator may also earn a performance-based commission if they achieve specific performance targets, as agreed upon with the participant prior to managing the fund. This model promotes clarity, fairness, and transparency in the handling of the takaful, contribution, and the composition of the operator. Next, wakaf-based model. The wakaf-based model is a relative new addition to the takaful landscape, particularly emerging from the participant in Pakistan. It was developed to help participants accumulate fund that can become a support future international or mutual aid efforts. And under this model, all participant contributions are put into a wakaf fund. And importantly, once these contributions are made, they are become a part of the wakaf and no longer owned individually. And instead, the fund is deducted entirely to the serving the needs of the participant collectively. And participant appoint a takaful operator to manage the fund. In return, the operator may receive a wakalah fee, or in some cases, a share of the surplus generated by effective fund and effective fund management. And this structure not only ensure financial protection, but also support the long-term charitable and cooperative value aligned with the Islamic principles. The last part is hybrid model in the takaful. The hybrid model in takaful combine elements from wakalah, mudharabah, and wakaf. This approach creates a flexible operational structure that leverages the strengths of each model while addressing their limitation. In the wakalah mudharabah hybrid, the operator receives a wakalah fee for a fund administration and acts as a mudarib, sharing in investment profits. This aligns incentive and maintains the Sharia compliance. The next is the Wakalah Wakaf Hybrid. The Wakalah Wakaf Hybrid involve an upfront Wakalah fee with the contribution going to a Wakaf fund managed by the operator. The operator may earn performance-based incentive if investment target are met. The Wakaf fund is used for claims and accumulative capital for future charitable distributions. Second in the Mudarabah Wakaf Hybrid. Contributions support both the risk sharing and investment functions. Funds are split between a risk fund and investment fund managed under the Mudarabah. Profit are shared based on a pre-agreed ratio, reinforcing and charitable intents. If a participant pass away before the maturity, the operator ensures that the designated Wakaf beneficiary receive benefits, and including any unpaid portion funded by surviving participant contributions. The hybrid model is recognized for its adaptable alignment of stakeholder incentive and support for socially beneficial outcome rooted in Islamic charity giving. It represents an evolution in structured Takaful product across diverse contexts. That's all from me. Thank you.
Next, we have the challenge in Takaful fund management. First challenge is intertemporal contribution mismatches, which is short-term versus long-term policies. One of the core challenges in Takaful fund management is dealing with intertemporal mismatches between contribution inflows and future liabilities. In practice, participants may contribute to a Takaful scheme for long-term coverage. For example, as family Takaful, while the fund needs to cover claims and operating costs in the short terms. This mismatch can lead to liquidity pressure, especially when investment returns are volatile or slow to materialize. For example, under a family Takaful policy, the early repayment is tiny in comparison to the eventual rewards anticipated. If the fund does not build up enough reserve to surplus or investment income, it may experience shortfalls. In contrast, general Takaful, which is short-term products, receive regular contributions but may not create long-term investment benefits, resulting in insufficiencies in fund utilization. Key challenges number 2 is portfolio diversification constraint. Takaful operators are required to invest only in Sharia-compliant instruments such as Suku, Islamic equities, Islamic mutual funds, and real estate. While this aligns with religious principles, it limits diversification in comparison to conventional insurers who have access to broader range of financial instruments, including bonds and derivatives, and interest-based fixed income securities. This limited universe of investable assets can lead to concentration risk, particularly in small or emerging economies, increasing portfolio volatility and reducing the capacity to optimize return across diverse risks such as asset classes. During periods of market stress or limited support issuance, Takaful funds may struggle to identify halal investment that match their risk-return policies and maturity structure. Now, let's move to challenge number 3, which is competition with conventional insurance. Takaful operators face significant competition from conventional insurance companies, particularly in markets where Islamic finance awareness and infrastructure are still developing. Conventional insurers often enjoy economies of scale, established brand recognition, and access to a wider pool of investment instruments, allowing them to offer more competitively priced products and higher returns. In contrast, Takaful operator may comply with Sharia principles, which governance practices, aiming to generate both financial returns and positive societal outcomes, similar